Hi there, Internet. My name is ᴜsᴇғᴜ, and I am one of eToro's most copied popular investors. I talk about compound interest quite a lot. I love compound interest. It is the patient investor's best friend. And because I talk about it so much, lots of people are asking me, how does it work? How do you forecast values and calculate them historically using compound interest? And so this is what that video is about. Let's take a look. When people ask me about compound interest, sometimes they don't realize that they're asking me about compound interest. They are looking at the table in front of us right now, the one that shows my returns, and they ask me why the sum of these numbers is not equal to the total. So if they add these numbers up, they're not getting the total. Similarly, I talk about my lifetime return and they add up the years and they don't get that number. And that's because this end value is not the sum of these numbers, but instead is the value of each of these compounding on one another, similarly for the years. The compound interest formula is well known. There are some slight variations of it, depending on a few factors, but this is more or less what it is. And in effect, what compound interest is the interest in a period on top of your principal and interest in previous periods. So if I invested 10,000 last year and I made 10% and I made another 10% this year, my 10% return would include the 10% return on my deposit last year. And so I'm calculating the end value of the interest on the interest. For this example today, I'm going to use the S&P 500. And the reason is that the S&P 500 is considered fairly low risk. It's more or less tied to the US economy. It's only going to tank permanently if the US economy tanks permanently, and that's fairly unlikely. There's also a lot of data about it. So the data in this table goes back to 1970 through to 2020. And I'll be using all that data because it's more interesting if we use real data. In terms of the data that I've pulled, there are the values that the index has returned per year here. And the second column, or third column, includes that value plus the dividends that were paid out that year. This index is made up of companies, and some of those companies pay dividends. And so you should be considering those dividends as part of the return that you're getting on your initial investment. So I will be using this column exclusively to calculate my numbers. Something to be aware of when you are calculating compounded returns, especially over multi-decade or even annual periods, is you need to account for inflation. So in the same way that we have the wonderful effect of compound returns in the S&P 500, on average, the inflation rate compounds with itself per year. So if there's inflation and it's 2% per year on average over a 50-year period, that is a hell of a lot of inflation. It's going to eat into your money. I'm ignoring that for this to keep things simple, but if you do the same, you need to make sure that you account for that. All right, so let's take a quick look at my examples. So here we have the table with all of the returns through 2020. The average return in the S&P 500 is about 10%. This is the historical average. And the historical return, including dividends, is about 12.2%. So I'm forecasting through the next 10 years, and I'll show you why in a moment. And so I've used that average of roughly 9% and more or less the same for dividends as has happened historically. So the first scenario is we found a time machine and we found $10,000 and we put on our bell bottoms and we went back to 1970 and we put 10 grand into the S&P 500. And we found a wife or husband and we had 14 happy children and 2 dogs, and we lived our lives until 2020, and we remembered, oh shit, we put that 10 grand in the market back in 1970. We look at our statement and it's grown to $1.9 million. Amazing. Even in 2020, that is a lot of money. But knowing what we know about compound interest, we decided, okay, the S&P 500, it gives an average of 9% per year, 12% with dividends. Let's leave it in for another 10 years. And this is where the magic of compounding becomes quite apparent. It took us 50 years to go from 10 grand to 1.8 or 1.9 million, but it took us only 10 years to go from 1.9 million to 6.5. And this is because of that concept of interest on interest. So what I'm going to look at next is something called cost averaging. People ask me very often, I've copied you with a certain amount of money, and now I want to add monthly or quarterly or annually. What do you think is the best strategy? Because I don't know the future and when the dips are going to come, I don't know the answer to that. And the way that people typically deal with this is they invest a certain amount on a schedule. This article is fantastic, and I will share this with everyone. And effectively it says, even if you had a crystal ball and you knew exactly when the dips were going to come, and you bought those dips perfectly, you would only slightly outpace someone that was cost averaging. And you would be a lot more stressed out. So no one can buy the dip perfectly. You can't time the dip. We don't know the future. So it is definitely better to cost average if you want to add money over time. So let's say you add $1,000 per year for 60 years, so we can compare the number. And so if we'd only invested 10 grand, when we invested only 10 grand, we made 6.5 million. But when we add $1,000 per year through to 2031, we instead make 14.1 million, which is quite a lot more money. And we expected to make more money, but we've only added $61,000, and we've more than doubled the return. All right, so that is cost averaging when compound interest is at play. What I also wanted to do was a lump sum scenario. Again, an article by the same guy, this time comparing cost averaging with investing a lump sum. Now, I understand that for some people, maybe you're making a bit of extra money every quarter, month, or whatever, and you want to invest that, so the lump sum strategy is not available to you. But if it were, this article talks about how lump sum, no matter the timing of that lump sum investment, will almost always beat cost averaging strategy. So we invested an additional 61,000. So let's say instead of doing that over time, we do it all at once. And now you see that instead of making the 14 million odd that we did when we were cost averaging, we now make $46 million. Now, I know that these numbers, these many millions, and these time frames of 60 years feel impossible, but they're not. You are going to live a long life, probably. And if you were to do this, and the S&P 500 keeps on making the returns that it historically has, then you will make these amounts of money over these time frames. So it's not that it's impossible, it's that as humans we have difficulty doing things that are boring and being very, very patient. We work against our own self-best interests because we want to do things that are exciting, and day trading is a lot more exciting. Okay. The last scenario that I wanted to take a look at is one that will show the drastic effect that small changes in these percentages can create. We were looking previously at the last 10 years on average returning 9% in the S&P 500, and we had our lovely returns of 46 million in that case. But let's say the next 10 years aren't great. Somewhere in those 10 years, there's a massive crash in the market, and it means that on average, the 10-year average return of the S&P 500 is only 2%. So even though it was only over 10 years, and even though it was only 7% lower, it means that the return overall is less than half. Well, yeah, less than half of what it would be. In the other case, where all the spending that's going into infrastructure planning and the decarbonization of the world right now means that we have a golden decade, let's say that the S&P 500 outperforms itself, and now we make 83,000. Now remember that change was only for 10 years, and it's just 7% higher than the average. All right, so hopefully by now I've shown you how powerful compounding can be. It can be very powerful in both the positive and the negative direction. I haven't shown you the effect of inflation, but it would be ugly if I did show you how much it would eat into our returns. So many of you are probably asking yourselves, why doesn't everyone just do this? And I've asked myself this question many, many times. It is far more exciting to be trading in and out of stocks all the time. When you see massive gains going on all around you, when you see someone else getting richer faster than you are, it can be very tempting to jump and change your strategy in an attempt to make those gains. It's very hard to be patient. It's very hard to be disciplined. And I don't think a lot of investors out there have a plan. And you need to have a plan in the stock market. I've researched this a few times, and there are better places to find the information than CNBC, but this had a fairly good summary that I wanted to show everyone on screen. So across many studies over many years in various locations, it was found that upwards of 95% of day traders and other people that trade frequently in the markets lose more than they make on an annual basis. So almost everyone is losing money, but they continue to behave the way that they always have behaved. And there's a famous quote. I don't know if this quote is true. I try to figure out if it was a true quote or not, but where Steve Bezos was asking Warren Buffett, your approach to investing is so easy. It's so simple. Why doesn't everyone just do what you do? And they would be fantastically rich. And Warren Buffett's response was, nobody wants to get rich slowly. And I think that is one of the biggest challenges that we face as investors, is understanding ourselves. And, we need to make mistakes. I spent 10 years in the market trying to get rich quickly before I was able to discover a strategy which in reality is very, very simple and has allowed me to achieve the returns that I have on eToro. All right. So thank you for your time. I hope that demystifies compound interest for you a little bit, and I will talk to you soon. Goodbye.